Thanks for joining us today on The Close. I'm Morello Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Statistics Canada says retail sales rose 1.1% in January compared to the month before. Sales in motor vehicle and parts dealers leading the gains. The strength was broad-based with increases in all provinces, including a nearly 1% rise in Ontario. Looking ahead, an early estimate points to a 0.9% gain in February, suggesting consumer spending is holding up despite the economic uncertainty. Iran is pressing ahead with attacks on Gulf Arab states, even after Israel signaled it would stop targeting the Islamic Republic's energy infrastructure. The war has killed more than 4,200 people across the region and brought shipping through the Strait of Hormuz to a near standstill. Iran's attacks on critical energy sites have eased from a peak earlier in the week, but crude prices maintained their rise after closing yesterday at the highest since mid-2022. The government of Ontario moving to protect ticket buyers by proposing changes to the Ticket Sales Act. The amendments would cap ticket resale prices and make it illegal to resell tickets for live events in Ontario for more than their original cost. There's been long-standing concern about inflated resale ticket prices. In a response sent to BNN Bloomberg, StubHub says resale accounts for only 9% of all event tickets sold, adding that such a move will hand monopolies like Ticketmaster a win and hurt fans with more fraud. Shares of Supermicro are sinking today. That's after 3 people linked to the company, including its co-founder, have been charged with helping to smuggle billions of dollars worth of AI technology to China. A new lawsuit alleges that Supermicro servers were used to illegally transport advanced NVIDIA chips to Beijing. The U.S. imposed chip export controls in 2022 to ensure China's military would not benefit from the technology and to slow the development of China's AI effort. Here is where we are on the markets right now. The TSX down another 644 points today. That's over 2%, taking it to 31,210. In the U.S., the S&P has a 112-point drop. That's 1.7% down. The Dow Jones, 1.1% down, a 500-plus point drop. And the NASDAQ, a 2.2% drop. It is down 489 points. The TSX down about 7% in the last month as that conflict in Iran boosts energy prices, but drags down so many other sectors. Let's start there with Carol Schleif. She's Chief Market Strategist at BMO Private Wealth. Carol, thanks for joining us today.
Thanks for having me.
Do you think investors are just getting more pessimistic as the conflict carries on?
Yeah, I think there is that piece in the beginning. There was that hope of quick resolution. And as we've seen several times in the past year or so, when you had quick resolution, the growth story went right back into motion. And so I think a lot of people were focused on that and that the underlying fundamentals going into this were strong and hoping for that quick resolution. But as it's drug on, and especially here on a Friday afternoon going into a weekend, I don't think anybody really wants to be super long risk going into the weekend.
Oh, okay. So the longer you mention it goes on, the more it will likely to infect inflation. At what point are you concerned about sustained inflation?
Well, it's interesting because you have to parse it out. I mean, investors were hoping for a quick resolution. We don't think this is going to drag on for months and months. And we do think the administration will continue to do what they can to try to find an off-ramp, if you will. As for inflation, it's really important to parse out that the global economy in general is very focused on energy and the throughput to inflation. It might have some translation, if you will, into stickiness depending on part of the economy or part of the globe. But North America in particular, the U.S. and Canada, are much less susceptible, if you will, in the intermediate and long term to having just energy translate through to substantially higher inflation. It might make it sticky in terms of it's harder for inflation to continue the downward trajectory it had been on. And more people now are talking about central banks putting hikes out there. We don't think that's the case in the U.S. in particular, but there's a lot of things for investors to consider. We just don't think that it's going to necessarily translate through into permanent inflation.
Okay. Are you at a point where you feel it could start affecting earnings?
It is something that will need to be watched because you'll have pluses, you'll have minuses. You've also got the vast moving part in here of artificial intelligence and robotics, people looking at reducing headcount and keeping an eye on margins there. But I think it's important to lean into the fact of how resilient these companies have been after shock after shock after shock has been thrown at them, or challenge after challenge in the last couple of years in particular.
So are there certain sectors that you worry about this more? The elevated cost of fuel for transportation, for example, or wrenched supply chains?
Yeah, you definitely have to watch the supply chains because they've been pressured over and over again. We'll have to look at manufacturing and construction because you've also got, in the U.S. in particular, for those companies, you've got tariffs applied to them. But you've got the interplay between Canada and the U.S. and Mexico eventually renegotiating, if you will, the CUSMA. So there's lots of different things at play there. But the consumer goods companies are going to have some difficulty. We'll have to watch retail in particular and some of those because consumers feel it. But oddly enough, sometimes the angst that we feel in one area causes us to go out and do that extra purchase or shift how things are done. So there'll be a lot of things for analysts to watch in coming months.
You mentioned how many different moving parts there are right now. The U.S. Fed held the rate. You talked a little bit about sort of the expectations, but what do you think will weigh on them more heavily or the heaviest as they move forward? What will be the biggest point of discussion for them?
Well, the thing that makes the central bank in the U.S. unique is that they've been given two objectives by Congress, not just in watching inflation, but obviously employment too. And they're trying to tease out the flatness that we've seen in employment, especially with the revisions that have basically put job growth at zero for the last year, as you heard Chair Powell mention in the FOMC meeting earlier this week. So they're going to have to tease out, is this inflation softening? Do they need to support the inflation part or the employment part of the mandate more energetically, if you will, than the inflation side? And so you've got that kind of creative tension going on in the committee, and because they are trying to figure out the technological impacts of what's going on in the employment market, as well as you've got immigration impacts, you've got lots of retiring baby boomers in there. So there's a lot at play in trying to figure out what's truly going on with the employment market.
A reminder of it being a midterm year. We tend to forget that with so much going on. Affordability has always been key for Americans. When does that have to be center stage for Washington? It's already March. The midterms happen in the fall. At what point do they need to make sure they have affordability under control?
Well, and I think that point is probably, according to the consumers, a month or two ago. And so there is a lot of focus, and I think that puts the pressure, that and the markets put the pressure definitely on all of the individual policymakers, if you will, not just the president, and the administration, but the policymakers as well, because we've had lots of initial dry runs. We've had caucuses. We've had some preliminary votes taken, and it's definitely showing up in the common vernacular that affordability is issue number one for all of us on the ground.
All right. So clock ticking already on that one. Carol Schleif is Chief Market Strategist, BMO Private Wealth. Thanks for your time today.
Thank you.
Coming up next, January retail sales in Canada showed resilient consumer spending, at least for now. Further insights in just a moment. Canadian retail sales rose in January by just over 1%, but experts say consumer sentiment could slow down demand with higher gas prices taking more money out of people's pockets now. Let's go to Sal Guattieri, Director, Senior Economist at BMO Capital Markets. Sal, thanks for joining us today.
Welcome.
more vehicles and parts sold at the start of the year. Do you see any clear reason for that move?
Well, auto sales have been a bright spot for the Canadian consumer for quite some time now. So that's really not a big surprise that we did see auto sales pick up at the start of this year. And the gains generally for spending were a lot broader than that. General merchandise, for example, was one of the biggest drivers in the month. So very welcomed. And I think the bigger surprise, because everyone thought that retail sales would rebound a bit in January after declining in December. The bigger surprise is that the Stats Canada's preliminary estimate for February was almost as large, almost 1%. And that is quite surprising, given that we know employment fell significantly, 84,000 last month. So overall, better than expected report. It does suggest that Canada's economy may avoid second straight quarterly contraction. We know that manufacturing shipments fell sharply at the start of the year. Employment was down in the first 2 months, and home sales as well were very weak in the first 2 months. But now that the consumer, the biggest driver of the economy, is pushing forward at the start of the year, the first 2 months of the year, it does look like our economy, real GDP, will rebound at least modestly in the first quarter. So that's quite good news.
Okay, let's look at a couple of the details for the sectors here. Food and beverage down for the start of the year, but that can't be unusual after the holiday season is over. I imagine people take a break. And then if you could tell me, when you look at grocery, and we know that has been popping up over a long time, 30% is the last number that I heard over the last couple of years. What are you seeing when you look at the grocery sector at this point?
Well, for the most part, spending on groceries has been pretty steady, and that's the fact, despite the fact that prices, food costs, have risen so much in the past three to 4 years. Now we're seeing some moderation in grocery store price inflation, but the fact is prices are quite elevated. Now, it does help that wages have also increased in the past 3 to 4 years. So that's providing a bit of an offset. But it is quite welcome that people are still spending at a steady rate, at least on groceries. Where they seem to be cutting back are some other perhaps discretionary areas, restaurants, for example, perhaps travel. Those are the areas they seem to be cutting back. But as far as the necessities, people are still spending.
Have the original tariffs that were announced last year, do you think, now move through? And how concerned are you about the new tariffs that were introduced and that could change again?
Well, what we're seeing is peak tariff was back in the spring of last year with the reciprocal tariffs. Now, Canada was avoided those tariffs at that time, but that's basically when our tariff rate, average tariff rate of goods shipped to the U.S. peaked as well. Since then, we've generally seen tariffs come off a little bit, and the big support was the fact the Supreme Court ruled against the administration's international emergency tariffs. That covered over a half of all the new tariffs introduced last year by the U.S. So that did get our average tariff rate down a little bit. It's running around 5% on goods shipped to the U.S. Now, that's largely because of the 50% duties on steel, aluminum, lumber is around that range as well, some copper products, and up to 25% on motor vehicles. Most of the other goods shipped to the U.S. are still duty-free. They have an exemption under the USMCA agreement, so that's very good. And we're hoping that this year, with the trade talks and the USMCA review, we do see some further relief on the sectoral duties in the U.S., especially steel, aluminum, and motor vehicles. That would go a long ways to, I think, supporting exports in Canada and perhaps inspiring some confidence amongst Canadian businesses once we get a little clarity on USMCA.
You mentioned the forward look in February still has it hovering around 1% for retail sales. The escalating cost of fuel, of course, is going to take a bite out of people's wallets. It's really costing them now to heat their homes, to fill up at the gas station. How much of a bite do you think that'll take out of retail sales in March and perhaps past that?
Yeah, hard to say how much of the hit we'll see immediately in March and coming months, but there's no doubt we know the direction. It's negative, and I mean we don't want to get too carried away. Canadian consumers are hanging in there. They're showing some resilience against tremendous headwinds, including the fact that we've created almost no jobs in the past year. So they're holding up reasonably well, but again, retail sales only up 1.5% in the past year to January. If you go back to before the trade war, January of last year, they were running at over a 5% annual rate. So consumers have definitely slowed their spending. And unfortunately now with higher energy costs, especially at the pump, that's going to drain spending power a little more. And it won't just be fuel costs, home heating costs. It will be food costs in particular because energy is such a big component of transportation and shipping costs for food. And the conflict in the Middle East is also pushing up fertilizer costs, which ultimately will push food costs higher. So not a welcome development, clearly, for Canadian consumers.
Sal Guattari, I must leave it there, sir, but thanks for your time. Have a good weekend. Enjoyed this conversation. Coming up next, shares of Supermicro sliding after allegations that the company's co-founder helped to funnel billions in AI hardware to China. More in a moment. Supermicro shares are under pressure after its co-founder and two associates were charged with smuggling high-end AI servers to China. We were joined by Mark Newman on this, managing director, senior analyst at Bernstein.
They're accused of essentially illegally diverting NVIDIA GPUs to China. And if you go through the indictment, which was just unsealed yesterday evening by US government, it really has quite a lot of details about what they did, including building fake servers to show in this company in Southeast Asia to kind of fool the auditors. And so they went to a lot of lengths to do this.
And so what are some of the charges they're facing? And the company's not named in this, but obviously it's paying the price for it.
Yeah, the company is not named. It's important to mention that. And in fact, Supermicro responded pretty much immediately with a statement. We put a link on that on our note to investors this morning, saying that, saying exactly that these are three individuals. The company's not named, as you mentioned. They're all the contract relationship has been terminated, and the two employees have been put on leave. I don't know the details about what the charges will be, if they'll be let off on bail, but they were two of the three were arrested yesterday. And I think this may go to trial or it may get settled out of court. We don't know the next steps. But in terms of impact to Supermicro, as you can see in the share prices, I think what's happening right now is investors are really questioning, is this another isolated case of rogue employees doing something bad, or is this just another, more evidence of systemic compliance gaps inside Supermicro? They've had accounting fraud allegations in the past as well. In fact, one of the co-founder, Wally Liao, who was arrested yesterday and is in this case, was also involved in the accounting fraud allegations before. And so, I think that's the worry here. Is this systemic? Is this going to keep recurring? Or is this a one-off? And I think that's why the stock is down so much today.
And going back to that one from 2018 when he resigned after that scandal and then rehired, why would a company rehire somebody who had been in the middle of something like that?
Well, that's exactly my question. It does seem quite spectacular that the same person who resigned, as you said, because of the accounting fraud in 2018, he rejoined around 2022 and then was promoted back to the board of directors in 2023. So he's a very senior person, brought back after those accounting fraud issues is also mentioned in the new accounting fraud issues, which were from 2024 as well. And so it seems to be a recurring theme, unfortunately. So yeah, it's a good question. It's a kind of fool me once, fool me twice type of thing, I think. Yeah.
That's George Bush, right? Shame on you, me, somebody. Okay, so how does the company bounce back from this? Can it bounce back from this?
It's a good question. I mean, we just have to wait to see how things settle out here. I think what we would worry about is if NVIDIA feels the need to distance themselves further from Supermicro because of this. And also not just NVIDIA, but I should say customers. Customers at Supermicro, are they going to want to distance themselves from Supermicro, and that moves business away? And I think this is why Dell's stock is up today, because Dell is the obvious beneficiary from this, because they are the leader in AI servers. Supermicro is the close number 2. This is AI server OEMs. And so any share loss from Supermicro, naturally you would assume most of that would go to Dell.
And how intertwined are NVIDIA and Supermicro? Would it be easy for NVIDIA to pull back?
I think it would be doable because they can just work more through Dell. Possibly they could, if HPE, because HPE has been playing a very, very small role in AI servers, have practically exited. Perhaps they want to get back into this. That could be an opportunity for them too. It would be huge volumes though, because we're already talking about Dell guiding to $50 billion AI servers this current fiscal year. They got one quarter orders, $37 billion. And so these are quite huge numbers. I think that could be possible to de-emphasize Supermicro and divert more to Dell and HPE. But it's not something that is that easily done. These are quite large volumes we're talking about.
Mark Newman, Managing Director, Senior Analyst there at Bernstein. A last look at the markets before the end of the trading day. Another dismal one. The TSX down today 1.8%, so 577 points is where we are down so far on the day. Across the border, a similar situation. We are over 1% down, 1.5% for the S&P, and it goes from there. We're back in a moment with the end of week numbers. Stay tuned. These are the closing bell for the end of the trading day and the end of the trading week. At the NASDAQ, Hondia's Capital Management ringing closing bell, and in New York, it's Guardian Metal Resources. We're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The red deepens on the North American markets today, with the tankers still pretty much at a standstill in the Middle East, and energy costs fueling concerns about sustained inflation, a fourth week of straight losses, with the TSX down 1.7% today. That's a 537-point drop. The S&P down today about 1.5%, about a 100-point drop there. The NASDAQ is nearing correction territory. It dropped 2% today, a 443-point move. Let's have a look at where oil is right now. This is West Texas Intermediate. It is just under the $100 U.S. Barrel mark, 98.32. So it's another $2.18 move up today, or over 2%. Let's get to the movers in Toronto. Gold and silver stocks extending the sell-off. That's Vizsla Silver and B2 Gold, both down today. Vizsla by 6.8% and B2 Gold down by 6.75%. Orla Mining is one that bucked the trend. It is up today 4.5% after reporting a fourth quarter revenue beat. Having a quick look here at the NASDAQ, Supermicro is one we have been watching. That plunge of 33% today, or $10.22 a share. after its co-founder was charged in a case tied to smuggled AI chips to China. Let's go south of the border. Bloomberg's senior equities reporter Bailey Lipschultz joins us now with more on this. Bailey, super micro stock paying the price for what is going on with a court case here, but Dell could benefit.
Yeah, Dell is perceived to be the big winner as it relates to chips. These have been kind of an inverse tandem trade over the last few years as investors try to wager on what companies would benefit from the AI boom. And we've seen Supermicro really kind of continuing to fall on its face over the last few years with a number of allegations or issues stemming around accounting. And the big takeaway has been that Dell is perceived, and at least from a fundamental standpoint, seemingly the big beneficiary from all of those shortfalls. When we saw the company's accounting issues come to light for Supermicro, it seemed like consumers and customers were flocking and shifting away some of their spending to Dell. And it does seem like if there is larger concern about what this ultimately could mean for Supermicro, again, they are not named in this suit, but if it does actually impact their underlying business, the fundamentals would point towards Dell being a beneficiary. Really choppy day to day, but Dell did end up managing to eke out a more than 1% gain on the day, and what really has been a sharp downdraft for technology companies. Again, be interesting to see, and we'll continue to track how this unfolds for Supermicro. But these dynamics where their fortunes diverge, seemingly at least on an intraday basis, continuing to play out.
Let's talk about FedEx then. They reported earnings last night. We had that. What did investors like today?
Yeah, they beat expectations. They really touted the continued demand. So far in the month of March, one of the things that stood out from management's earnings call comments last night was that they are, not really exposed to the ongoing issues in the Middle East, the ongoing war, and B, they positioned around the ultimate knock-on effects of that. And it does seem like they're continuing to grow market share against some of their competitors. We did see a bit of a mixed reaction from UPS and some of the other shippers, and that they are still advancing their plans to spin out their freight business in early June. So it did seem to tick all of the boxes for investors and analysts. Obviously, again, this is a stock that was up much more sharply, if you will, when the market was hanging in there, and did again eke out gains and close at the highest level in a couple weeks.
Okay, let's get to Mosaic. That got hit hard today. What's driving the sell-off?
The stock was downgraded by an analyst, really citing the issues around input costs. So the fertilizer business, if you've watched these stocks, look a little bit like an EKG over the last few days. And this does seem like it's a question of their ability to try to expand or raise prices to maintain their margins. The analyst downgrade really calling out at least their perspective that the input costs are only going to go higher as long as the war kind of rages on in Iran, and as long as the Strait of Hormuz is either fully shut or at least slowing to a near standstill. That impacts their inputs and how impacts their ability to deliver and sell fertilizers. Again, not raising prices as quickly as we continue to track the events around the world. The big question ultimately is the knock-on effects for the supply chains. And when you look at an industry like fertilizers, according to some analysts on Wall Street, there will be winners and losers. And at least according to the downgrades that we saw today, perceivably Mosaic is going to be stuck range-bound, if not more of as an underperformer.
All right, Bloomberg, Bailey Lipschultz, have a good weekend, sir. Thanks for your time. We'll take a deeper look at the end of the week with that deep red of the North American markets. We're back in just a moment. As the conflict in the Middle East carries on, the North American market sell off, deep declines to end the week. Let's go to Youngyu Ma, Chief Investment Strategist at PNC Asset Management, to talk about what we have been seeing. Thanks for joining us today.
Thanks. Great to be here.
Would you now call this a major shock to the markets?
That's definitely a major shock to the market. A lot is coming together and not in a good way. So I think there are many variables in play here. Of course, it's the energy cost, but we also now have rising yields on long-term sovereign debt. We have strains in the credit markets as well. We have the Fed here in the U.S. Pulling back from the notion that rate cuts might be on the horizon later in the year. So a lot of this picture is, if you describe what a favorable picture might look like and you inverted it, we're getting a lot of that today.
Okay, you say that something like this often changes the landscape further down. Can you give me an example of either what you expect or a time in the past that this has happened?
Well, yeah, there are many times when you get some type of market turmoil or shock that takes place, and on the other side of that, you have a very different investing landscape. So if you think of the dot-com bust, for example, what you had on the other side of that, you had value outperforming for a long time. If you think of what happened prior to the financial crisis, coming out of that, we had low valuations for a long time, but eventually technology took the leadership. So the question that we think investors should be considering now is, eventually we'll have de-escalation, and it obviously is going to be a bumpy path until then, or at least that's how it looks right now. But what does the investing landscape look like on the other side of this conflict in the Middle East now? And we think a few things are going to be prominent. One is that what was before perceived to be broad-based growth, not just in the US, but in the global economy, is probably going to be more restricted. And so it's going to be probably incumbent on investors to see where growth is going to come from. Of course, technology is a big standout in that consideration. But the other thing is energy security. Energy security, even clean energy, we think is going to take a very strong renewed focus in the subsequent months after de-escalation. And a lot of countries and companies are going to be asking themselves how they achieve greater energy security, and that's going to lead to a lot of investment and probably an increased focus on green energy or renewable energy as well.
Interesting. I'm a little surprised by you seeing a focus on clean energy, considering what's going on in the U.S. with the turn away from cleaner energy by the administration. Where are you seeing right now signs of bottoming out?
Well, signs of bottoming out are somewhat fleeting. You tend to see them a little bit taking place, and then you get a big shock like happened today in the markets, where the escalation or expected escalation in the Middle East is leading to another bout of concerns. But we are seeing some signs that are at least somewhat favorable under the hood. We do think the software turmoil in the software sector or in the software industry that had been seen in prior months is probably behind us, and that's in the rearview mirror. We do think that there's going to be stabilization in the AI-related space and the companies that filter into that. Once there is more de-escalation that takes place. So we do think that's an area where there are positive signs. We do think areas such as utilities, once this move up in long-term interest rates stabilizes, we do think utilities should provide some stability here for investors as well. But again, when you get days like today, almost nothing works. And that could be, you could get a few more bumpy days or bumpy weeks like this before you see broader signs of stabilization.
What about the private credit concerns? Are they, in your mind, overstated?
We do think they're overstated. At least the broad concerns that private credit strains could lead to a larger and more significant drawdown in the financial sector or in the economy writ large. We think they're overstated in that sense. Are there strains that are real? Absolutely. But there are already markdowns that are taking place. We think that we're going to have continued redemptions. There's going to be continued gating. But if we think about where pricing of some of the business development companies are today in terms of trading relative to the assets on their books, we think it's probably already priced in. A lot of the strains are priced in, and we could very well get to a point in the coming months where there's too much discounting that's taken place and actual opportunities start to arise. So we don't think the strains in private credit are going to ripple throughout the economy in a way that really derails the economy, but we do think some of these strains are real and not going away soon. That's true.
What's your one piece of key advice today for investors? Given all that we have discussed and how much is changing, what would you say to investors?
Well, probably the biggest piece of advice is the single word of patience. We think this conflict in Iran could go in multiple directions. There could be earlier de-escalation than is potentially pointed toward right now, but this could be drawn out for a longer period as well. And we do think that there's underlying stability and strength in some areas of the economy that will ultimately reemerge, but we do think that we're going to get days like today where nothing works. There's a lot that's being pressured in the markets, and until we see greater signs that the stability in the energy sector is more on the horizon. We don't need complete de-escalation. We don't need complete resolution, but we need a path toward stability in the energy sector, and that can be something that helps the markets to bottom. But in the meantime, I think we just have to get comfortable or accept the idea that there is extreme uncertainty right now, and whether or not this uncertainty lasts for another week or two or another few months, I think is very much up in the air and very difficult to predict here.
Got it. Young-Yu Ma is Chief Investment Strategist, PNC Asset Management. Thank you for your time, sir.
Thank you.
Coming up next, then there's gold, why it is pulling back during this time of uncertainty. Back in a moment. Spot gold has dropped almost 11% since the start of the conflict in Iran. How far does it have to go? Let's go to Chris Looney on this, Director of Natural Gas and Gold Strategist at RBC Capital Markets. Chris, thanks for joining us today.
Thank you so much for having me.
Investors often go to gold as a hedge against inflation. Why is it not performing at a time when it is uncertain, ever more so than it has been in a long time?
That is a great question, and certainly one that we've been getting quite a bit recently. The reasons are a fewfold. You know, at the outbreak of the crisis, you started to see the dollar regain its safe haven status and start to outperform. You also saw yields rise, and both of those things really held back gold's performance in the immediate aftermath of the crisis. But as it dragged on, I think it begged some more questions. If we think about the types of uncertainty that gold has traded on the back of so far over the last, 13, 14 months, whether it's trade and tariffs or politics and government shutdowns and Fed independence or geopolitics in Greenland, if you think about these uncertainties, they're very broad or pervasive and thus difficult to really hedge in a single market. And I think what makes this specific type of uncertainty, the war in Iran, different is that there is a very clear line to energy, and that's where a lot of the hedging is happening. That's where a lot of the positioning is happening. And gold's role is that catch-all perceived safe haven, that catch-all hedge against these uncertainties just hasn't been necessary to date. And so when you couple that with some of the macro moves, plus this different type of uncertainty that we're seeing, gold just hasn't really been the go-to asset to hedge it. And now with some of the inflationary concerns and the read-through for the Fed, that's also falling on gold's shoulders at the moment. And that's why I think you've seen gold really underperform. But there is the potential for that to change in the future.
Okay. Have central banks or retail investors been doing the selling, or both?
It seems like, just looking at ETF holdings, you've seen a pretty significant drop, at least 2 million ounces, according to the tickers that we're looking at, and also our own data. And so it does seem that investors are taking profit. Maybe that's counterintuitive considering how far gold has fallen, but it's risen much more over the past year. And so there's a lot of those positions that are probably still in the money, and you're starting to see some profit taking there. But generally, institutional investors broadly have been quite quiet. And I think it has a lot to do with the volatility that you're seeing in markets and the uncertainty at play. It's just a specific form of it is not playing out in gold's favor this time.
Okay, so what do you think is boosting the American dollar, which, with the conflict in Iran and their debt concerns, right? What do you think continues to boost the American dollar?
That's the real question. I think probably best place for an FX strategist. But from gold's perspective, watching the dollar get back its sort of safe haven bid and sort of re-strengthen, I think the broader questions are out in the future. Like, if this conflict is at one point behind us, what sort of trends do we go back to? And I think that's where you start to see the potential for gold to regain some favor. It would require the dollar to weaken probably at some point. We've certainly seen the dollar take the baton from rates, which I think was the biggest driver last year from a macro perspective. So it is really all about the directionality of the dollar, and the shift during this crisis has been to the dollar's benefit and gold's detriment. I think if this crisis drags on, a lot of things could change, one of which actually brings us back to the uncertainty. If you really start to see these concerns about the inflationary environment and the potential knock-on effects for economic growth, if this really drags on for a long time, that's when I think gold's catch-all role as a safe haven could change. And so macro factors could change, but so could the type of uncertainty that gold is pricing on the back of.
Okay, what are you doing as far as putting a price on gold for the future? What is your target price for 2026?
Yeah, so we've actually stayed steady in our gold view since the start of the year. We've long said that gold should spend most of its time in the $4,500 to $5,000 per ounce range, a range which actually increases towards year end around our Q4 high of 5203. Obviously, with this move, we were trading above that for a while. We stuck with our view. We're now trading well into that range and actually right around the bottom, 4,500 today. But I still think that's a relevant range for gold to continue to trade in. We may be at a low now, but I do think that the uncertainty will start to play a more gold positive role at some point, particularly as this crisis drags on. So we're sticking with our view, and we do think that gold can regain its footing before year end, but we're certainly stuck within this range right now and definitely on the low end, as you can see, based on current prices.
All right, Chris Looney, love the name. Thanks for joining us. Chris is Director of Natural Gas and Gold Strategist at RBC Capital Markets. Paying over face value for tickets for live events could be soon illegal in Ontario. More on that in a moment. The U.S. president now says he does not want a ceasefire with Iran, adding, quote, "You don't do a ceasefire when you're obliterating the other side," end quote. Trump also lashing out at military allies for not helping to unblock the Strait of Hormuz, claiming NATO does not have the courage to act. And he said that despite the current blockage, the strait would eventually open on its own. The Ontario government is moving to cap ticket resale prices at their original value 7 years after scrapping similar rules. We got more from Stephen Crawford, Ontario's Minister of Public and Business Service Delivery.
Our legislation today goes much further than what was available before. So we are now capping the resale ticket marketplace at face value. So people will be able to resell their tickets through various vendors that we have in the marketplace here in Ontario, but they will not be able to sell it more than the face value and, of course, the fees that are associated with that as well. So that'll be enforced as soon as we pass the legislation, assuming it passes sometime this spring, but it will be fast approaching, and we're excited to announce this because we believe this will make sporting and cultural events here in Ontario much more affordable for families and people that are looking to go out and enjoy some of these events.
It's obviously been a problem for some time, the sky-high prices of resale tickets. But again, how are you actually going to enforce it and make sure that they're not being resold on third-party websites?
Yeah, so we're going to have a stronger compliance division. It all falls under my ministry at the Ministry of Public and Business Service Delivery and Procurement. We're going to put additional resources into enforcement. We will also be consulting to see whether we should increase the fines for people that are taking advantage of the system right now. And I think that that's going to be an important part of this as well. So it's stronger enforcement, more visibility, more consumer awareness to legitimate sites.
So increasing the fines so far isn't part of the initial legislation?
That's to be determined. The initial fees right now are $10,000, but we are looking at increasing that to $25,000 potentially.
We do have a comment from StubHub today. I'm going to pull it up on the screen so that our viewers can read it. It says StubHub, it says Ticketmaster Live Nation just walked away from an antitrust trial in the U.S. with a slap on the wrist and its monopoly intact. Now Ontario wants to reward them by targeting their competition with a bill straight out of Ticketmaster's playbook. Instead of handing the company that brags about robbing fans blind a win and enacting a policy that hurts fans with 4 times more fraud, leaders should focus on real reform that actually reins in Ticketmaster's prices. So for its part, Ticketmaster has said it doesn't actually set prices, but these are some strong words coming from StubHub, Minister, in regards to Ontario rewarding Ticketmaster. What do you make about these comments?
Well, I wouldn't view it that way at all. What we're focused on is helping the people of Ontario be able to afford family, cultural, sporting events. We know what happened with the Taylor Swift concert a year or so ago. We know what happened with the Jays World Series tickets, where people were selling them for 300, 400, 500% above market value, and that's just simply unacceptable. And we know that StubHub and companies like that, listen, they're legitimate resellers. We welcome them here to work in Ontario, but they're not going to be able to take advantage of people. And if they are in this market, and we hope they will be, I'm sure they will continue to be, they'll be able to charge a fee on those tickets, but they'll have to change their business operations to adapt to the market. I think we're also going to be sending a signal to a lot of the illegal bots that are operating in Ontario right now, which unfortunately have always tried to get ahead of the systems in place to prevent that. And I think a lot of the bots that are coming in right now and buying high demand tickets very, very early, taking advantage of the people of Ontario, are going to move to other marketplaces that are less regulated, because there's no market in Ontario. There will be no market in Ontario anymore to resell those tickets at extreme high prices. So we think we're going to help clean up the market and make it more fair for the people of Ontario.
SeatGeek has also warned that this could make tickets more expensive. I don't know if you've heard what SeatGeek has had to say. It says that this shifts costs in a way that are harder to see, whether through higher base prices or fees buried elsewhere in the transaction. Do you agree with that?
Absolutely not. The ticket prices, first of all, are set by the artists. So let's be very clear on that. So any artist, be it Taylor Swift or U2 or the Rolling Stones, whoever are playing in the province of Ontario, they sit down and set up the ticket prices. So StubHub and SeatGeek and other ticket resellers simply make a profit on the spread between what the ticket was originally at face value and what the new market price will be. So I don't agree with that whatsoever.
We've seen fans also getting scammed by buying resold tickets on platforms like Facebook Marketplace, as you mentioned Marketplace, I think. But could the government explore protections that lets consumers recover their money if they e-transfer someone who never sends the tickets?
Well, we have a very strong consumer protection division here in my ministry. We'll continue to enforce that. But, we really believe that the people of Ontario, if they are reselling their tickets, they should go through legitimate ticket sellers. And you've mentioned a few of the names of those companies that are operating in the province of Ontario. And we have a very fair, safe, and transparent marketplace for secondhand sales tickets and resale tickets right here in the province of Ontario. And we would encourage all Ontarians to go through that marketplace. And our ministry will certainly continue our education awareness program to make sure Ontarians are aware of that.
So I take your point, as you were mentioning at the beginning of this conversation, your government is exploring higher penalty fees, but that's not going to be in this initial legislation. Do you not think it should be, to really enforce this and make people not want to actually try to go around the legislation that you're introducing?
Well, first of all, there's already a fine there right now. But secondly,
but a higher
we are going
fine.
to consult. We want to talk to people. We want to talk to companies and see how the marketplace handles this. But like I said, we are very willing to take stricter regulations and stricter enforcement should that be needed. We're very open-minded on that. We'll see how the marketplace evolves on this. But having said that, again, we're very confident this is great news for the people of Ontario, who are going to be able to afford, finally, going to some of these high-demand events, and they want to take their families and go with their couple kids to a concert or a hockey game. I think this will put them in a better position to be able to do that.
When will this cap come into effect?
The cap will come into effect, assuming the legislation is passed. It'll come into effect right away. So that will be very, very soon, certainly this spring and before the FIFA events that are expected in the early summer.
Stephen Crawford, Ontario's Minister of Public and Business Service Delivery. Up next, Meta kind of backtracks on the metaverse. What is the cause for the flip-flop? We'll find out in a moment. Meta is backtracking on its plan to shut down the metaverse. NVIDIA gearing up for its next major phase of growth, and Amazon reportedly preparing a new smartphone. Let's go to Carmi Levy. He's a tech analyst, and he joins us now to talk about all these stories. Carmi, thanks for joining us. So we'll start with metaverse, which failed to be the next big thing Mark Zuckerberg had hoped it would be. The announcement this week, though, really kind of does mean there's not much left of it.
Oh, yeah. I mean, I think we're all just waiting for the last person to leave and turn the lights out. They announced on Wednesday that they were finally killing kind of the centerpiece technology of their metaverse vision, specifically the Horizon Worlds app, that they were going to turn it off on their Quest and VR headsets on those platforms. It would still be available for web users, but it's not much of an experience on the web. There was apparently an outcry. I don't know how big it was, but the company backtracked yesterday saying they're going to keep it alive, that they're not getting rid of the metaverse anytime soon. But the writing is on the wall. They have spent at least 70 billion, if not more, upwards of 80 billion, depending who you talk to, how the math works out, on their Reality Labs unit, which developed the technology. They created this app that was so laggy, janky, just really creepy, frankly, that even their own employees refused to use it. Senior executives had to send emails begging everyone to download and use it and test it. And that it just never found a market. It's kind of like a technology that doesn't have a killer app. No one really appreciates what it's for, what the benefit is. It was supposed to be, Meta's really big play in post-social media life, but it just didn't work out that way. And of course, AI came along and changed that priority for the company. It can't afford to support both. And so even though they say we're not getting rid of it now, the truth of the matter is Meta is in the fight of its life for artificial intelligence. If not supremacy, then at least remaining competitive. It can't afford to fund both as it goes forward.
Okay, let's get to NVIDIA then. It's got a $20 billion deal with Grok. Tell me about what advantage NVIDIA gets from this.
So Grok specializes in, and that's Grok with a Q, not Grok with a K. This is not Elon Musk's AI bot. Grok is a technology company that specializes in something called inference. And so that's once your large language model is trained, how does it deliver the answers to you in real time when you ask it a question? So, for example, when you ask a bot something, it's thinking in the background and you kind of see it thinking, and then it's spitting back that answer in real time. How does it go through all of that training data and come up with insights that sound and feel like those would be from a human? That's what inference is, and it's largely it's kind of like it's the holy grail of AI. Whoever does inference best has the best model, has the best services. And so NVIDIA basically acqui-hiring Grok, bringing on some of their senior leaders, including their CEO, and incorporating this technology into their very offerings. That's a huge coup. It means that that their technology will now power the data centers that power AI workloads, and their technology will do it better than any other chip maker's technology, which gives them a massive advantage.
Is this something that will have to go through regulatory hurdles?
It certainly will, and they're already getting some attention because there have been allegations that this puts NVIDIA in a monopoly position, that it essentially means that any other chip maker simply can't compete, doesn't have the ability to operate on the same level. So certainly that scrutiny is underway now, but we're already seeing them score deals, for example, with Amazon Web Services to incorporate this very technology into Amazon data centers, which up until now, that's a massive change. Amazon has traditionally developed this technology on its own and has held it very close to the vest, very proprietary. And for them to allow NVIDIA in says something. They know that this is groundbreaking technology. And of course, so on the one hand, it gives them huge advantage in the market, but on the other hand, it attracts the attention of regulators as well.
Okay, let's get to Amazon apparently wanting to re-enter the smartphone market. What do you think of that idea?
If at first you don't succeed, try again. I remember back to 2014 when they introduced the Amazon Fire Phone that was supposed to revolutionize e-commerce on a mobile device. Technology wasn't quite fully baked. The market wasn't ready for it. And we all know within a year, it had flamed out in rather grand fashion. Here we are 12 years later. Now they're calling it the Transformer. And they're saying that it will align with their existing online services. So think Amazon Prime, Amazon Music, Amazon Alexa Plus AI powered, and it'll be an AI powered experience that maybe will deliver on some of the promises of that original phone. We've heard this before. Quite frankly, I don't see it doing anything that a traditional smartphone can't do. Just like in 2014, this is a huge lift, and Amazon can do a lot of things. I don't think it can revolutionize the smartphone market with one product introduction. Not even Amazon can pull that off.
Okay, I guess we will wait. We will see. Carmi Levy, thanks for joining us. Appreciate your time.
Thanks so much, Marilla.
Coming up, diesel prices have been rising faster than gas prices since the start of that conflict. We'll find out why in just a moment.
By lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them.
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
Since the start of the conflict in Iran, oil prices have risen dramatically. However, not all petroleum products have been impacted equally. Looking at the transportation sector, diesel prices have been rising faster than gasoline. For more on what this means for the global economy, we were joined by Tom Kloza, Chief Energy Advisor at Gulf Oil.
Ahead of March, diesel inventories around the world were much, much tighter than gasoline inventories. You have to remember that the molecules that power a truck or a tractor are very, very similar to the molecules that are used to heat homes in a lot of places. And we had a cold winter, so a lot of those molecules went into that product. More recently, natural gas prices have gone up, not so much in North America, but certainly in other continents. And diesel is kind of the alternative for powering up a lot of stuff there. So, you know, generally across the world, it's the highest growth product, maybe with a little competition from jet fuel. Everybody gets excited about gasoline, but gasoline is kind of the unwanted hydrocarbon sometimes.
How much has the conflict in the Middle East, though, really factored into all of this?
Oh, it's been a big deal. I mean, not only do we get crude oil from the Middle East, but we get quite a bit of diesel. There's a couple of refineries in Kuwait and the United Arab Emirates and certainly Saudi Arabia that make diesel that tends to go to the North Atlantic basin, whether it goes to Europe or in some cases to the United States. And clearly that refined product isn't coming out of the Persian Gulf right now. If you get a situation where Iran is targeting more refineries or refineries outside the Persian Gulf, it would manifest itself in just crazy high apoplectic diesel prices.
You know, we obviously are looking at this chart right now, just so showing how much diesel has gone up. We're talking about it. We were looking. There's the chart again. So we know they've surged dramatically. But can you really put it into perspective for our viewers, like just how big of a move this is, as we're seeing that white line there just skyrocketing?
Yeah, I'll put it in this perspective. You know, they trade with the price of crude, clearly, and crude oil prices are, you know, have moved from about $70 to about $110. So that's a big move. But the other thing that's happened is that gap between the diesel price and crude oil has widened tremendously. You know, for the first 10 or 20 years of this century, diesel fetched a price of about $10 to $20 a barrel over the price of crude. Right now, it's fetching a price anywhere from $50 to $100 over the price of crude. So the beneficiaries, not because of any collusion, but simply because of the vagaries of the market, are really the refiners that make it, particularly if you're talking about refiners who have access to tidal waters. I remember hearing from new refineries coming up in Saskatchewan and Alberta about how, you know, if they had access to tidal water, the world would be their oyster. And they were interested in railing it to British Columbia, you know, to sell to China and other places.
Interesting. And as you say, like diesel is by far a faster growing product for the world than gasoline. So as you mentioned, particularly if this conflict continues and there's more strikes on energy infrastructure in the Middle East, this could just be a continuously escalating problem moving forward as there's more demand for it anyways.
Yeah, it would be the worst product in terms of one of those scenarios where some more refining gets knocked out is probably jet fuel. Because you just don't store a lot of jet fuel for one reason or another. I mean, you want to make sure that when you have jet fuel in a tank, it's up to specifications, whereas diesel can sit around a little bit longer. And if we see some more impediments there out of the Middle East, yeah, it's the product that could go to, it went to $6 a gallon back in the Ukraine war, the Russia-Ukraine war in the spring of 2022. The difference then between now and then is that war impacted somewhere close to 1 million barrels a day of molecules, they're different products. This one has impacted about 18 times as much oil that moves out of the Persian Gulf. So this is not hyperbole. They're not exaggerating when they're talking about the problems with the Strait of Hormuz being closed. It's probably costing the world another $1 billion a day just in hydrocarbon costs because of what's happened.
Wow. So what would need to change, do you think, for diesel prices to come back down? And is there a world where they do come back down, or do they stay elevated?
No, we need to get the Strait reopened, and perhaps that'll be on a limited basis. Maybe they'll do 50 or 70% of what they did beforehand. But if you don't open the Strait, then you really do bring in the possibility of $150 to $200 a barrel crude, as things manifest themselves. And, prices for diesel that look like monopoly money kind of prices, $5 to $10 a gallon and $5 to $10 a gallon on gasoline. So let's hope they open the Strait at some point. It may be quite dangerous and there may be various interruptions, but this does not get solved if the Strait remains closed.
Tom Closa, Chief Energy Advisor at Gulf Oil. Shares of Canadian-based Orla Mining up today after it reported record gold production for the fourth quarter. It beat in revenue and reported growth potential in its Musselwhite and Nevada mining locations. For more, we were joined by Jason Simpson, CEO of Orla Mining.
Our conviction is that by 2028, we can get to 500,000 ounces, and we're pursuing 1 million ounces by the end of the decade. So the 300,000 ounce mark was important in 2025, and we've guided to a midpoint of guidance in 2026 to 350,000 ounces. So as I like to say, that takes us part of the way on the journey for Orla Mining.
There's a lot of different projects to talk about. So we'll start with the South Railroad project, which is showing some results. How critical is this asset for Orla's next phase? And what are you expecting in terms of future numbers? Yeah, that's the important first asset to talk about this year, because we're beginning construction at that mine this year, continue through next, and it'll represent our third mine in the Orla portfolio. So that'll be the focus of our attention over the next 2 years. It'll add about 130,000 ounces per annum of gold production. Importantly, at very high margins. Another open pit heap leach, similar to the operation we have in Mexico. These open pit heap leaches are tremendously cash generative. The Mexican asset is what enabled us to graduate into Nevada and then eventually Canada last year. And so we look forward to bringing it online and adding to the annual production and cash generation of the company. Let's talk about the Musselwhite acquisition. How has that improved production and geographic exposure? Musselwhite was an absolutely transformative acquisition for us. It more than doubled our production, and as exemplified in our results, is now our largest mine and really is the anchor of our business. And so it will continue to produce over 200,000 ounces a year, added to the 115 that we produce in Mexico midpoint of guidance this year. That's what takes us to the 350 midpoint in 2026. The interesting thing about the Canadian asset is that we believe that we could do two things there. One is extend mine life considerably, and the second is that we had many years to go and a lot more gold to harvest. And last year we demonstrated that. From underground, we clearly had indications and will be able to increase for many years the lifespan of Musselwhite.
but from surface, we were able to push that gold mineralization out for 2 more kilometers, so effectively taking us out for many decades of cash generation from our Canadian asset.
There was also some new discoveries at the Musselwhite asset as well. Is that right? Like 2 kilometers below the original mine?
Yeah, it's actually an extension of the existing mine. So that mine has been producing through the great employees and stakeholders in that community for over 25 years. It's produced 6 million ounces of gold. When we acquired it from Newmont, we knew that we were acquiring a little over 1 million ounces, but we believed that it could continue even further than the 6 years that Newmont had outlined. And so we demonstrated that last year. Drilling holes from surface some 2 kilometers away from the last mine working, we were able to intercept that gold formation that continues. So what does that mean for Orla investors? If 6 years and 6 kilometers of mining over the last 26 years, 6 kilometers has generated 6 million ounces of gold. We just added 2 more, so we've tripled the potential resource at Musselwhite. Again, emphasizing our conviction that we'll be there for a long time harvesting gold out of the Musselwhite deposit. The other discoveries are surrounding the deposit. There's gold that we've discovered on surface, almost unbelievably for such a legendary camp.
What's the cost, though, of continuing to mine in those deeper areas?
Yeah, that's an important feature of a Canadian underground mine. It is a different cost than an open pit heap leach mine like we have in Mexico and our building in Nevada. So certainly it's a different cost profile, but we believe we also have a strategy to reduce the costs. There's really 2 elements we'll focus on. More production clearly drops the cost per ounce, and we've already demonstrated that we're going to be able to deliver more and reduce the cost that way. But also by improving some of the infrastructure at the site, we actually believe we can reduce the total cost of the operation. But we're always going to have a remote fly-in, fly-out operation, an underground mine, and from that very nature, it will be one of our higher cost mines. But when you aggregate that with the 2 open pit heap leaches, we're comfortably into the first quartile of costs, and predictably at today's gold prices generating significant cash from all of our operations.
We are almost out of time, but I did want to ask you, just in terms of like the geopolitical factors around the world right now that might be impacting your company. You know, what we're seeing is the price of gold obviously has been dropping. How do you manage any kind of risks associated with things like that?
Yeah, so I'll answer that question from 2 perspectives. One is the revenue that we generate. I think most gold miners and my peers are comfortable in these gold prices. We are building a company that would be resilient at gold prices thousands of dollars lower than what it is today. So we would certainly like to maximize the revenue that we're generating and increase the value that way. But at $4,500 gold or $5,000 gold, we're making tremendous profits, and we'll have a company that survives at all parts of the gold cycle. On the cost side of things, and I've gotten a lot of questions about our fuel exposure and so on, you know, listen, wars are inflationary, tariffs are inflationary, and so we are not immune to inflation. However, each company has different exposure to it, and we use fuel as an example. In our operations in Mexico and Canada, the majority of our fuel is used in Mexico. We only have about a $25 million U.S. exposure to fuel prices. So therefore, in that example, you can see that Orla is not particularly exposed for fuel inflation and so on. So we are extremely comfortable with our cost of our operations to be able to produce free cash flow, as demonstrated in our results last night at all gold prices and in any macro inflationary environment.
Jason Simpson, their CEO of Orla Mining. A reminder here of how we ended the week. You might not want the reminder. Here it is. The TSX Composite down 1.7% today. That's a 537-point drop. Pretty dismal week overall for the North American markets. The S&P 500, a 1.5% down today, or a 100-point drop. And then the Nasdaq down over 2% today, 443-point drop. Of course, all of this affected by the price of oil and shipments frozen in the Strait of Hormuz. Oil today, this is West Texas Intermediate, up at 98.32 by the end of the day. So up 46% over the last year period. You see that spike just this month. That does it for the close. Thanks for joining us today. We'll see you on Monday.